I hope everyone's doing well and welcome back to another video. So it's been a little while since we've done a lesson. I think we've had very many lessons this year so far, which, it's not a bad thing by any means. I think the content is quite comprehensive so far on the YouTube. And this year the focus has really been on, sort of the outlooks and trade breakdowns, lots of midweek outlooks as well, something different this year. And the big reason for that is I want it to be very sort of action oriented, right? There's only so much teaching you can do. Sometimes you just have to, see it from the perspective of actually doing what we're meant to be doing. And what I mean by that is, let's take the gym, for example. Imagine you have somebody, you're teaching them how to do a bench press. You can give them all the pointers in the world. You can tell them this is, imagine I'm showing you guys or you're showing somebody else. This is how you do it. You have to, place your hands here, feet here, blah, blah, blah. All this talking and showing yourself, but until that person does it themselves, it's very difficult. And that's the sort of idea with the outlooks and everything, putting you guys more in that position of, this is what I'm thinking, right? And was doing it for the future. It's not in hindsight. It's like, for the upcoming week, for the upcoming day or whatever it is, this is what I'm thinking. And then, of course, the trade breakdowns are more in-depth breakdown in hindsight, which breaks down why we did certain things. But anyways, that's not the point of this video, right? Just the insight into why we do the content a certain way. This video, we'll be talking about swing trading. I was initially going to make this a PowerPoint presentation, but I don't think we need to. I think, again, it's easy to just do on the charts. But just for sake of you guys following along and myself as well, this is what we're going to talk about, right? Swing trading as a whole, pair selection, and we will also talk about trade. I think these are the core sort of principles that need to be discussed to get a good understanding. So let's start with number one. What is swing trading, right? Now, so far on the YouTube, very sort of comprehensively, what we've covered is what we know as intraday trading or potentially even scalping. The lower the time frame we go, the more is considered scalping, around the 1, 3, 5 minute. Intraday, I would say, sits between the 5, 15 minute, maybe 30 minute, maybe even 1 hour potentially, right? And swing trading, I would say, borders at that 1 hour, 4 hour, and any charts higher than that, right? And sort of investment or long-term trading would sit on the high time frame charts. We're talking about, potentially the, going past the daily, the weekly, into the monthlies, etc. But anyways, we're going to focus on swing trading. Why? So I think swing trading is very misunderstood. The majority of people think, I don't want to be in a trade for so long. And, if I trade the 5 minute in and out quick, yes, it's true. Everything has its pros and cons, that's standard. But swing trading, I think, and I've genuinely come to the realization, I think is much more favorable than people would think it is. I think intraday is seen as the sort of gold mine, you get there quick, more trades, more setups, blah, blah, blah. But maybe the laid back approach is better for a lot of people, right? Maybe using the swing trading approach could serve as an easier, more stress-free way to trade, right? And why is that, right? Now, of course, we started with the basics. We're trading on a higher time frame. We trade on a higher time frame. That means price will, of course, be moving slower, right? Now, we'll take an example. We'll cherry pick any random example here. Well, let's just go with, we'll mark this out. Let's say we took this out, right? This is a short on gold. Let's just assume you had the trade set at the equilibrium. Again, cherry picked, I know, as a wick day, perfect entry, whatever. And you simply just targeted the local low, right? We'll just go with that 1R, right? Nothing crazy, the most basic setup you could have. Now, what is the premise, right? Sort of rewind premise of a OTE or having a clear range like this. The premise is, right, and what do I mean by that is that we have a high and a low. The premise is that this high is an area you don't expect to get violated if you are bearish, and the low is a target you expect to get hit if you are bearish, right? That's how the OTs work usually, right? So in this scenario, all we're doing is giving ourselves a favorable entry, so our risk can be equal. Ideally, it would be better than equal, would be entering a little higher. Again, we're cherry picking the example, and in that scenario, that didn't happen. Let's just say you entered off the equilibrium. This is on the 1 hour time frame. Let's assume you've seen this up, right? Price has tapped your entry. This is at 9 a.m. New York time. So this is in the middle of New York kill zone on Thursday, sorry, right? You've entered and you've used 2% risk. Price has hit the take profit in the next couple of hours, right, within about 3 candles, and you've just made 2%. Do you think that's a bad trade-off? 2% in about, 2.5 candles, let's say. I wouldn't say that's bad at all, right? The reason I spoke about the premise of the OTE is because at the basis of swing trading, right, what is swing trading? Technically, every single one of you watching this, if you watch the rest of my content, is a swing trader to an extent. Because when you do your analysis for your weekly candle, for your daily candle, when you make these predictions for pricing, price can make the high here, the low here, go this way, you're essentially laying the pathway for a potential swing trade. The only difference is usually we don't act on that. We don't take these swing trades. Instead, we trade intraday. We wait for the lower time frame confirmation, blah, blah, blah. And then see, do we want to entertain this, take it away or not? On the high time frame, we don't really do that. Don't wait for a lower time frame confirmation. It's really and truly as simple as these sort of OTEs. Now, this is the most basic entry. Clear high, clear low, good target to go for. You enter, you use higher risk and you can get in. Now, why use higher risk? Now, I'm not saying, see, if you start swing trading immediately, 2% risk, that's it. ASAP, that's it. The reason you are able to use higher risk, and it makes a bit more sense to, as time frames, sort of get higher, is because you may be sitting in these setups a bit longer. Now, there's pros and cons to this, right? Sitting in these setups longer means if you risk 1%, then now imagine you may have waited quite a while just for your trade to make a return, and you make a 2%, which may still be good, but imagine it took quite a while. Let's just say it took like 2 days or something, right? Now, if instead you use 2% on that setup and the setup took 2 days and it returned you 4%, you're going to think that's amazing, right? I think that makes a lot of sense. So when I say we should risk 2%, or don't get it skewed, right? Let me rewind on that. Let's not risk 2%, but rather we can afford to risk a bit more. And this is why. This is the major pro of swing trade. Pro is that if price was to move against us from here all the way to this stop loss, how much space do we have? How many candles would price realistically have to move this way for us to think, okay, hold on, it's going against us? Because guys, this is the 1 hour time frame. If in this example price had tapped us in, started trading here, and you start thinking, okay, you know what, this daily candle is looking a bit suspicious now. I think it's headed this way, and the likelihood is that if this daily candle doesn't hit my stop loss, the next one will. And you have so much time to react. So even though you risk 2%, let's imagine price had reached about here, you close it, you still manage to, get off with only losing 1% or whatnot. Now, when I mention risking 2%, I wouldn't really be doing this on live funded accounts. I think it makes a lot more sense to do on a challenge phase, especially if you're not going to be trading as often if you're swinging. But I will leave that as a sort of discussion for a different outlook or a video about how to go in terms of risk. But all I'm trying to say here is there's the idea of you can potentially afford to risk a bit more given the sort of logistics of the trade. I've also touched a bit on the trade management already now in regards to how price will essentially move a bit slower. Of course it will. You're on a higher time frame, your target's a bit further away. So that gives you more time to react in a good or a bad way. Because, for example, the second that this candle had closed, right, this one here specifically, it is the 11 a.m. candle. You see such a nice clean move away, and this is a clear swing point. Break even straight away, right? Now let's just imagine on the lower time frame, right? We'll entertain it for example's sake. When price tapped you in, we decided to be intraday traders. You get this bit of displacement, and this is not a bad setup at all, by the way, even intraday. But you decided to take this setup. What price did then was run higher instead of just OTE and carry on lower. And when it ran higher, it stops you out, and then it carries on lower. Why has it stopped you out? It might have just hunted the previous hourly high. That might be it. No other major reason. When you're on the higher time frame and you're swing trading, as we said, you're essentially dealing with the higher time frame bias. So if you are correct and you're in line with that bias, and you take a setup in line with that bias that ticks all the things you need for a good entry, the odds are you're not going to get stopped out unless you're wrong, unless I was wrong about gold being bearish in this example, and it went this way, I would get stopped out. Otherwise, you'd be happy to hold that trade knowing, I'm confidently bearish. This is where we are going next. This is my clear bias for the next day, for the next week, whatever it is, right? Now, here's another major pro of swing trading, and it can lead into a discussion about pair selection. Let's simplify things, right? Now, I said swing trading is very aligned with your bias. Right? What do I mean by bias? Just what we look at for the week, what we look at in terms of our weekly outlook, what we look at in terms of our, daily outlooks on what, right? It really sets the framework in that sense. Have an expectation for your weekly profile and whatnot. So how does that feed into pair selection? Because in my opinion, right, to formulate a good swing trade or have a good idea of, higher or top forming, all you need is a clear read on the next daily candle or the next weekly candle. Now, the same can be said for intraday trading, right? That if you have a good read on the next daily candle, yes, if it trades your way, you can hit the setup and whatnot, whatever it is, right? It's true. But just as I showed you guys a minute ago, or rather made an example of gold, where, on the 5 minute, if it ran a bit higher, stopped you out, then you're annoyed and you may not re-enter. Whereas on the 1 hour, if you're onside, it goes your way, you're very happy. And the likelihood of you getting stopped out, if you're correct, is much lower, right? The same ideology behind that, right, is that if you have a good read on the upcoming candle, taking a swing in that direction is probably very favorable, right? You're confident in that direction. For example, here, if I'm confident in gold longs, we're coming from a daily fair value cap. If I'm confident in price going back up to the high, and I think this is, the current sort of low that's going to put in, all I have to wait for now, I have this sort of new range on price, right? If you take this far range, I think it'll be a little bit clearer on drop one time. I'm not giving this as a signal, by the way. I don't think this is a great setup yet by any means. It has the potential to be, but I don't think it is just yet, right? If you were to take this gold long and you're confident that this daily candle is the new swing point, right? If essentially, let's rewind it, let's, keep it simple. This daily candle is starting to look like a swing point inside a daily fair value gap. You're in a bullish context for gold. You expect gold to go higher. Now you think to yourself, what is the current range for price, right? The current range for price to be bullish is from this low to this high. That is if you don't expect previous week low to get violated, which I don't at the moment. So therefore, if this is a low I don't expect to get violated for the time being, and I know I have a new week opening up, then what's the odds that this new week opens up, trades lower here, sweeps all of this internal liquidity, comes into the discount, right? And let's say we hit this. Let's just say, right, for the sake of just getting in the move, right? That's all we want to do. We just want to get into the move. We take it at equilibrium, right? Price sweeps all that internal, hits you at equilibrium. From here, you're confident that this is the last swing point before the new all-time high. You could even target the all-time high. And here you manage to end up with a very ambitious position, or rather target, if you are correct with your bias. Now, this doesn't mean I'm saying, risk 1% and just hold your trade to 5%. Wow, you're going to kill it. It be smart, right? If price comes and sweeps this high and it's the end of the week, you might just close it at the 3% and think to yourself, you know what, I'll probably get another opportunity to re-enter and go to the high. It's never a one-way move, is it, guys? Like even in here, right, if we take this leg of price action where it seems very one-sided, how many retracements are really offered, right? Even if we go on the lower time frame, even lower than this, I'm sure there's a lot of good entries offered. So just always bear that in mind, right? Same way with intraday, same way with swing trading. You don't need to chase entries. Let the entries come to you. If the first one doesn't, if your drawn liquidity is intact, there's a good likelihood you'll still get another chance to get in line towards it. So yeah, so back to the point. In pair selection, why does this make things a lot easier? Now we're trading a higher time frame, things are much slower. What we can now afford to do, because we're not going to be glued to our screens, and we're not going to, just sit on the 5-minute time frame waiting for setups to form, is actually now start looking at a lot of different pairs. I could just simply go to, I have reason to believe that this week stocks are going to be bullish. Let me go look at NQ, right? Let me go look at NASDAQ. Let's actually take a look at S&P as well, right? Let's look at, that. Okay, you know what? Let's look at Dow Jones. Now, why are we going and looking at all three? Because now it's up to you to decide, okay, this is the one I think is the most bullish. This is the one I think, if a long setup is offered, it's going to be offered here. I think NQ at the moment is the most bullish, right? So now I can think to myself, okay, if NQ is the most bullish, right, what is the sort of setup for price that I would warrant as a good entry? In my opinion, the current good setup would be like this. If this is an accumulation, price comes and sweeps this manipulation and the distribution this way, that would be, I think, the ideal setup on NASDAQ at the moment, right, for the time being. Someone told me how to turn this off. I couldn't find the setting. Let's quickly check. Sorry, guys. I believe it's this. Make this out. There we go. Perfect. So yeah, if price can come and sweep these lows, and we can see this as a sort of accumulation, manipulation, distribution, that would be a great setup, right? So all we're saying there, right, is essentially, sorry if you come in, is that I'm expecting a previous weekly low sweep. Once that is swept, I think this low will stay intact and I want to see price go higher. So what can we do? Very simply, you could say, I'm going to enter at the previous weekly low sweep, right? You potentially may not wait for lower time frame confirmation. You could if you wanted to, and I'm going to target this strong liquidity, right? Not a bad setup at all. And the point that I was making, the reason I shuffled between the S&P, the NASDAQ and gold and all of these pairs is, what we're saying is every market moves, right? At some point, something every day in the markets is moving. Now, I'm not saying go and assess every single pair in the market. No, I'm not saying go look at CHF, JPY, start looking at these crazy exotic pairs. Stick to liquid pairs, stick to things that actually move. I wouldn't really venture from the majors, right? The pairs with the USD in it usually, unless the DXY is in a big consolidation. The stock market is always a good one to keep your eyes on. Gold right now is a good one to keep your eyes on. But what you can go ahead and do is just think to yourself, look, I've got a very nice weekly close. Which of these markets right now, right, it might even just be as simple as going, it's showing me a very clear weekly close, right? Which one is giving me a reason to believe that we're going to trade one way or the other? Now, for example, just by opening this chart, I've already identified I'm bearish on the dollar overall. This is the dollar traded against the yen. We have sitting duck targets here, equal lows. So this is a chart that is potentially, maybe not right now, but setting up for some sort of good swing trade low. So now I can think to myself, okay, what is the current range for price for me to short from? I would say we can take it from this high to this current low. And would you look at it? We're already in the premium, right? You could even hit a long-term trade. Now, these weekly trades are a bit more difficult, I'll be honest with you guys. If you're on a prop firm and you've delegated your capital to a setup, maybe if you just set this on one account and you're trading a different account, it may work, right? It may work out for you. But otherwise, it may be difficult to take this up and then also be looking at other setups at the same time, right? And you might also get flagged for risk on certain prop firms if you have too many setups on. But essentially what I'm getting at is, we know that this is a market with a good range. We've had a good, sort of weekly closure pushing into this premium, and we know shorts are expected. We're in a good area to short from. So you can work with that, right? What I told you guys, we could even really and truly next week, if we wanted to, if we're confidently bearish, which I would argue we are, set it at the previous weekly high, stop loss at the high. You could probably even place it a bit lower if you wanted. I wouldn't, again, remember, this is a weekly context. I wouldn't expect price to trade up here. If it trades up here, by then I'm most likely out of the trade anyways. You could just target this lot, right? And there, you formed a very good, quick and easy setup. So that's the same principle you guys can apply. You can go look at a bunch of different pairs. You can start, having a list of these are the pairs. And now you can make it even simpler than that. If you don't know which pairs to look at, all these pairs are getting, very confusing for you, let's just go to our Forex Factory and see which pairs have movers this week, which pairs have red folders this week. We expect some sort of movement. Just look through that list really quickly. What has the red folders? Okay, GBP, USD, AUD, GBP, popping up a few times, right? And they all have red folders. Now, we already spoke about EU, GU in the outlook, so I won't cover it. But we'll just quickly go take a look at AUD USD. You know, is there anything formulating? That's crazy. That's a markup from I don't know how many years ago, but ooh. Just same thing. You guys can do a quick analysis. You know, what do I expect to see from price? Where are we coming from? Where are we going? What's the current raw liquidity? Is there a good, you know, area to long from? Is there a good area to be shorting from? The weekly, yeah. Now, unfortunately, I'm looking at this chart. This doesn't look very clean to me. It doesn't look like there's anything that I would entertain. There's nothing that's screaming out at me, and I would think, wow, like, I want to hit towards here. You know, maybe hit a short towards these, but you know, overall, this chart does look bullish. It just doesn't look like it wants to provide a clear bullish opportunity. Whereas the way we logged onto the USD JPY, and immediately it was clear, right? We had a good range, we had a good target. If you go ahead and look at USD CAD, I think we already looked at it. Maybe not. Yeah, sorry, I just opened it for a second. You can apply that same principle. And if you guys want to get really complicated, well, not complicated, but a bit more advanced, we can start looking at currency futures, right? Which is over here. These are essentially the currencies split into their own charts. This is just the euro on its own. This is the pound on its own, the yen, the Australian dollar, CAD, etc. So now what we could do is if, for example, euro is having a clear print, we have a clear bias on this, and you have a clear bias on our DXY, then you know they're probably good to trade against each other, right? If, for example, this is clearly bearish to you and the DXY is clearly bullish, then it will probably offer a great sell, right? That's market synchronicity 101. But yeah, that's another thing you guys can use. Very simple, just coming out of the futures category. But even simpler than that, at the basics, what I would keep it at is that we want to see a good weekly closure, or rather a good weekly read on the upcoming candle. Is there an obvious good candle coming up? Is there an obvious good, you know, daily candle coming up? Like, is there a good range for us? Is there a good place that we know we don't expect this to get violated? Right? Is there a good place for us to say, yeah, we can target this? We have reason to target that. Does it match with your forest factory? Do you expect it to move? Right? Are you entering in a safe position? In terms of the entry itself, it's nothing different. Right? It's the same principles as your lower time frame. The only thing is that usually things are moving slower. And if anything, you can actually allow yourself to be a bit more aggressive in terms of where you put your stop loss. Because, for example, in this scenario, let's just say, yeah, I wanted to take this sort of range for price and go long on gold. Right? Let's just assume I'd hit this already from, you know, we're just going to make it up. We just hit it from here. And we're expecting to target the current all-time high, right? What you would have done is probably put your stop loss here at the one. But then looking at this chart, I would argue that if price reached the bottom of this fair value gap, right, it's not guaranteed, but we talk about the likelihood. If price reached the bottom of this fair value gap, the likelihood is that price will, you know, trade away from us. I mean, sorry, apologies. If price trades to this low, it will likely trade to the stop loss. What I was getting to, got ahead of myself there, is that if that doesn't make you comfortable, what you could simply do is say, oh, you know what, this array has been respected. I think price will hold this. So what I'm going to do is when the new candle opens, new daily candle opens, I'm just going to enter and I'm going to make sure that I cover this array, because I don't expect price to, you know, violate this. If it trades lower again, I still think it'll respect the daily fair value gap. Otherwise, my bias is wrong. It's invalidated, and you keep the same target. And that's a bit of a safer way to enter. But as you guys can see, similar to intraday, you can be very, you know, creative with it. But what I would do is I would go ahead and test these things. Go look at the 1 hour OTEs. You know, even 1 hour OT, as I said to you guys, you could even consider that intraday trading. But you see how it's much safer and less stress to enter on these. Go look at your 4 hour, your daily. How do they form and how do they set these things up for you? So what I would be looking at is keeping it simple and not trying to get too fancy with these things, right? But I really, really hope you guys are able to take something away from this video. I hope it helps. And as usual, any questions, anything I can help with, just drop a message below.